If you think financing a barndominium works just like financing a regular house, stop right there, because this is where a lot of people get blindsided. You can have the land, you can have the plans, you can even have the income and the credit, and still get told no. Not because you can't afford the project, but because the lender doesn't understand the property, the appraiser can't justify the value, or the loan structure collapses halfway through the build. And here's the worst part. Most people don't find this out until they're already emotionally and financially committed. So in this video, I'm going to walk you through the real truth about barndominium loans, why so many banks reject them, the appraisal trap almost nobody talks about, how much money you may actually need up front, the hidden danger during the construction phase, and the smartest loan options if you want to get approved without making a costly mistake. If you're even thinking about building or buying a barndominium, watch this to the end, because one of these mistakes can cost you tens of thousands of dollars. Barndominiums have exploded in popularity for a reason. They offer open layouts, customization, workshop space, and in many cases, a lower build cost than a traditional home. But when it comes to financing, they still get treated very differently from standard houses by a lot of lenders. Non-standard property with uncertain resale value. And lenders hate uncertainty. That's why so many buyers make the mistake of walking into a big national bank saying, "I want to finance a barndominium," and then wonder why the conversation gets awkward fast. The issue is usually not just you as the borrower, it's also the property itself. Lenders have to follow loan. Can I get a loan? Ask, does this lender actually understand barndominiums? Because those are two very different questions. Truth 2, the appraisal can kill the deal. Now let's talk about the biggest trap in barndominium financing, the appraisal. This is where a lot of dream projects go sideways. In a normal home purchase or new construction loan, the lender wants proof the property is worth what you're borrowing. That proof comes from the appraisal, and appraisers usually determine value by looking at recent comparable sales in the area. But what happens if there aren't enough comparable barndominiums nearby? That's the problem. If the appraiser can't find enough similar properties or enough unique homes that reasonably support the value, they may struggle to justify the number. And if the value comes in low, the bank will usually lend based on the appraised value, not your build cost and not your emotional attachment to the project. In some cases, if there are no usable comparables, the lender can deny the loan entirely. Fairway. This is why two identical borrowers can have two completely different outcomes. One gets approved in an area where barndos are common, and the other gets stuck because the appraiser has nothing solid to compare. That's also why rural areas where barndominiums are more common may give you better odds, especially for USDA-eligible purchases, because the property type may be more familiar and comparable sales may be easier to find. So before you fall in love with the design, understand this. Your floor plan does not determine loan value, the appraisal does. And that one detail can decide whether your project moves forward or dies on the spot. Truth number 3, the down payment and cash needed may be higher than you expect. Now, exact down payment requirements vary by lender, loan type, credit profile, and whether you're building or buying an existing barndominium. But one thing is clear, barndominium financing is often less flexible than a basic conventional home mortgage, especially if you're dealing with construction. Some lenders want stronger credit, more documentation, and more money into the deal before they feel comfortable approving a non-traditional property. Rural First, for example, advertises financing for many barndominium builds with as little as 15% down and says they don't require a higher rate, bigger down payment, or shortened terms just because it's a barndominium. But that does not mean every lender will be that flexible.
A lot of borrowers assume they can walk in with a standard low down payment mindset and get the same treatment they'd get on a cookie-cutter subdivision house. That assumption can get expensive. And beyond the down payment, you also need to think about closing costs, inspections, utility setup, site prep, permits, possible land improvements, and unexpected overruns. Because with a barndominium, the build itself is only part of the financial picture. The smartest buyers don't ask, "What's the bare minimum I need?" They ask, "How much liquidity do I need to survive this project without stress?" That is a completely different conversation. Truth number 4. Construction loans don't hand you all the money up front. Here's another thing that catches people off guard. Construction loans don't work like a giant lump sum check. The money is usually released in stages called draws based on milestones in the project. That means the lender typically reviews the work completed, may require documentation and inspections, and then releases the next portion of funds. The process is designed to make sure the money is going toward completed work and materials already tied to the project. Sounds simple until real life hits. Because if paperwork is incomplete, inspections are delayed, permits run into issues, change orders pile up, or costs run over budget, the release of funds can slow down. And when funds slow down, subcontractors don't get paid on time, schedules slip, and your stress level goes through the roof. This is why having extra cash reserves matters so much during a build. Even if the loan is approved, your project can still become a cash flow nightmare if you don't understand how draws actually work. So if you're acting as your own GC, managing subs, or building a heavily customized barndominium, you need to think like a project manager, not just a borrower, because the build can be delayed even when the loan is technically in place. Truth number 5. You can get approved, then still lose the permanent loan. Now here's the part almost nobody warns buyers about. Getting approved at the beginning does not mean you're safe at the end. With construction to permanent financing, some loans require updated documentation when the loan converts to permanent financing. Fannie Mae's guidance says if the borrower's credit, income, or employment documents are too old at conversion, they must be updated and the borrower re-qualified based on the new information, Fannie Mae. So this is not the time to wreck your debt-to-income ratio. Do not assume that because your build is underway, your financial behavior no longer matters. This is not the season to finance a truck, open multiple new credit cards, take on new debt, or make risky income changes unless you've spoken with your lender first. Because if your numbers change the wrong way, the construction phase may be moving forward while your permanent financing becomes more complicated than you expected. So while your barndominium is being built, one of the smartest things you can do is keep your finances boring, stable, and predictable. Boring wins. The 5 main loan paths. So what are your actual options? Let's break down the 5 most realistic paths. 1. Construction to permanent loan. This is the most common route for a new build. During construction, you typically make interest-only payments.
And most importantly, do not shop for a barndominium loan the same way you'd shop for a normal suburban house. This is not just about finding the lowest interest rate.